we are looking at this, with this panel, at the global outlook in venture capital. I want to ask the panelists to quickly introduce themselves. Let's start with Noor, who's joining us from Dubai. Noor, just a 1-minute CV of you, please.
Thank you. Thank you, Matthias, and thank you for having us here. So my name is Noor. I am based in Dubai. I run a venture capital firm called Global Ventures. We invest across the Middle East and Africa. We have about 50 companies across the portfolios in Series A. And we have a firm with 30 people on the ground across from Lagos, Cairo, Saudi Arabia, the UAE, really focused on enterprise tech and regional founders that are scaling globally from the region. So that's us in a nutshell.
Thank you.
So my name is Joyce. So as you can probably guess, I work at Preqin on the research insights team that was set up a couple of years back now. So my background is predominantly on the buy side, working for pension funds and insurance companies, allocating into emerging markets, mainly public equity, but also some across the private space as well. And essentially what we do on the research insights team is we delve into Preqin data to answer or try to answer client queries as best as we can. And then we publish that research as part of the Insights Plus product. So that's my background.
Hello, I'm David Moscato. I'm founder and managing partners of Quarantia Capital Advisory. We are an advisory boutique focused on venture capital and alternative investments. Alternative investment, mainly hospitality and digital assets. In venture capital, we are focused on early stage. We're scouting roughly between 150 to 200 startups. And we pick up roughly between 10 and 12 per year to help in capital raising. In addition to that, we also search and select investment early stage for venture capital funds, venture capital companies, and family office. In addition to that, we also work as advisor in the closing of the deals between the startups and also the investors. So a sort of facilitators of the transactions. Also, after the deals, we are involved into the governance of the investments, depending on the appointment from the investor or the startup. So that's, in a nutshell, our activities.
Good afternoon, everyone. My name is Barjasic, and I'm the CEO and founder of Connectology. We invest in early-stage companies. We do a wide range of investment readiness services, accelerators, and we also provide governmental advisory about stuff like co-investment funds and tax breaks in emerging markets. I'm also one of the board members of the European Innovation Council that hopefully I'll be mentioning a little bit about later. And apart from that, I've been working for years with, for instance, with World Bank, European Business Angels Network, and organizations in this kind of pan-European early-stage market. Thank you.
So just two words about myself. Matthias Knab, I come from Germany. I started in 2003 the first digital newsletter on hedge funds. We broadened it. We cover private equity, venture, crypto, everything that's alternative. Now, let's look at the market downturn, right, in the public markets that we're all witnessing and suffering from. Karen, just continue from your presentation. Is this downturn, particularly NASDAQ, tech, et cetera, how is that affecting venture capital valuation and the outlook of venture capital?
Well, I think the short answer is, in terms of the immediate impact, there's not a great deal happening. I think, as we've heard a few times today, valuation multiples are remaining more or less where they are. There will be more pressure going forward, of course. I think looking back at the sell-off that we saw in March 2020, it's probably fair to say that in many respects, the financial markets never really had the opportunity to have a proper crisis, because we saw the sell-off in risk assets, but then we've seen such a swift recovery that there wasn't enough time for that to feed through into private markets. And now, you know, as you point out, we've seen the sell-off in the NASDAQ, but of course that kind of masked the reality, because in a way, it's the more speculative, loss-making tech names, perhaps those kind of names that should have remained private equity or venture capital backed in the first place. They've sold off particularly hard, and I think, you know, if you compare this to 2020, it's more difficult to see a reverse, from the Fed, and unless there's a complete abort mission and we go in the other direction very quickly, it's very difficult to believe that that sell-off won't continue. And so in other words, it does have to feed through into private markets and venture capital in particular. I think just going back to the previous panel as well, I mean, there was a lot of discussion about valuations in private equity. That's a place where we're less concerned overall, because we think if you look at private and public equity valuations across the board, they're not as severe as we've seen in pockets of the public and venture capital market. But I think, given the effective long duration of venture capital, that poses additional risk for this asset class. So I think the interesting thing, though, is, again, as we've discussed, there's something in the region of $500 billion worth of dry powder in global venture capital currently. So that's certainly going to cushion the impact. I think we're going to see more difficult financing rounds going forward, clearly. We're going to see more structure in deals. We're going to see probably reluctance from founders to accept down rounds, but eventually that's going to have to happen. And then you're going to see a distinction between the high-quality names, high-quality venture capital firms that have good assets that can still grow into those valuations, and then you're probably going to see a section of the market that's going to do less well. So I think overall, that's how we see things.
One thing, I also want to continue the question that the lady here asked about Central Asia and the role of these hubs, right, that we have in venture capital, right? So Silicon Valley has become almost the overword for venture, because there's so much activity there. And it's not only there, you got these hubs in London, of course, in Austin, in the Nordics, Stockholm, Berlin a bit, Middle East is coming up, and now also in Africa. Noor, you operate in the Middle East, right? And you also have strong connections to Africa. Can you explain to us the role of these hubs? And particularly now in the Middle East, is there more emulation or imitation, or is there also real innovation coming out of these, call them secondary or minor hubs?
So, I'll caveat and then say that no one's immune to this crisis, right? Public, private, Europe, US, the Middle East. So we're all going to feel a little bit of this correction. I think the region as Middle East Africa, which is how we define it, is 1.5 billion people. And when you take a look at the population demographics, I'm sure many of you know this, 50% of that population is under 30. We've been saying this for a while, which then naturally means that as these people grow up, we've now hit that cliff where these people are becoming, or this demographic is becoming, a very productive member of the population. And so whereas we may have had 10 years ago a lot of emulation, and we invest in the emulation, the Venmo for the region, the Uber for the region, and so on and so forth, what's more interesting and notable in our part of the world is the innovation that's coming out. And in the innovative landscape, and a lot of the things that we have invested in have innovated genuinely in the region and then exported the innovation into the US and Europe. And I mean, I'll give one example, which is a company we're invested in called Proximi. So the founder was a surgeon in Lebanon, couldn't get to enough places fast enough to help people. So started literally streaming with her buddy surgeons. Fast forward a couple of years, we invest in a company at a $35 million valuation that has an augmented reality platform for hospital ORs. Thinking emerging markets. Can we bring in specialist surgeons from the UK or the US into emerging markets using this augmented reality? Now the company has raised from Maverick, Questa, F-Prime, Advent at a $200 million valuation, has done 14,000 surgeries, but largely between, for example, London and rural England, where the chance of a fatality or a complication in the rural areas is 3 times higher than central London, right? But the innovation happened because people couldn't get to enough places fast enough. And so there's many examples like that where it's not that our founders are trying to think outside the box, it's that for them there is no box. They're leapfrogging. There is no legacy. There's nothing that they have to fight in terms of there's a system and legacy that have been built in Web 2, and therefore let's move that to Web 3. or in traditional, and now we're streaming. No, Web 2 doesn't exist. Most of the infrastructure doesn't exist. So as we're innovating, we're thinking, here's a problem, here's a technology, how do you solve it? There's no box around there. So that's the kind of innovation we're seeing, and I could go on, I won't. But in mobility and sustainability, the founders are sustainability first, right? So when we're investing in mobility, we're investing in companies that have a net zero impact simply because energy is too expensive. Electricity is undependable. So when you think about what they're building and how they're building it, there isn't the abundance of capital they've had, so they've been profitable or sustainable from year 1 or year 2. Right? We don't wait to get to a Series C to think about how is this company profitable. And it's true innovation that is solving real-world problems that can be exported everywhere.
But also tell us a bit more about the whole ecosystem of venture capital, say in the Middle East or in Dubai. Because I've been going to the Middle East, I don't know, since 2004, 2005. And at that time, they used to be more trade financed, right? And then there was a certain wave where they opened up to hedge funds, etc. How far has venture capital been able to penetrate the local investor base? Institutional, but also, family office, high net worth. How much is it part of their allocations and their research processes?
So I'm not privy to answer what percentage of a family office's allocation goes to regional VC, but I will tell you this. When I started the firm about 4 years ago, and I said, we want to build a VC firm for the region, and I've always been focused on, let's build the firm. The funds are great products, but let's build a firm because there is no firm across the region, which seems kind of unacceptable. And the ecosystem was nascent. Our fund one was $50 million. We invested in 22 companies. We do mainly Series A. We predominantly do B2B because it's more capital efficient and there's no capital in the region. And this was kind of groundbreaking. So $50 million was a real fund. Our last fund, and that fund, a 2018 vintage, has, for those that like numbers, a 0.7 DPI, a 2.7 TVPI. It's a top decile by PitchBook, sorry, not Preqin standards, right? And so it's done incredibly well by emerging market standards. To your point, emerging markets have different standards. Now when you take a look at the ecosystem, and back then, most of the money was raised abroad. The region did not invest in the region, to answer you. So our investors were largely US sophisticated VC investors that had done Brazil, had done China, had done India, and could pattern recognize that this part of the world's at an inflection point. That year, the region had $400 million in venture for MENA. The whole year, all deals. Last year, all of MENA, all the countries, all 467 deals by all the funds, the whole year, had a whopping $2.6 billion invested. That's like one Series D round in the Bay Area. So you stop and you think that this is the size of our ecosystem, right? And yet, it's 480 million people. It is a growing demographic. It's a growing consumer base. So it's still very nascent. And a lot of that money did not come from the region. We've had Sequoia come into our deals, Tiger, Dragoneer. So you have all the international funds starting to invest in our part of the world. But the region is late, even in our own backyard. But it's there now. Now we have a lot of regional capital saying, we believe we see it. There's enough success stories, enough exits, enough unicorns that the region is starting to get behind it. But traditionally, I think that the region was young in its venture expertise, right? And so whereas the US and Europe had 20 or 30 years of venture expertise, so could pattern recognize and support and invest, the region was coming up to scratch on their educational level of venture, which now it is. So now the region is very much investing in itself.
Great, you're certainly in a great spot. Great, so let's do that. I won't save your questions for the last 5 minutes, right? So if you have a question, if you have a comment, if you have a suggestion, right, please raise your arm. I will scan the room now and then and really try to pick you as you have the question. So don't wait for the last 5 minutes. We still have 20 minutes to go. Any questions so far regarding Middle East and what we discussed? Any suggestion, comment, feedback? No, but remember, raise your arm. So we're now changing from the Middle East to Europe, all right? David, why don't you start, right? You are working mostly here in Europe, in the European ecosystem. What do you see happening here? What excites you about Europe at the moment?
Yes, I must say that, first of all, we are focused mostly on specific clusters of early-stage investments. So to be clear, our main focus on target the best, the most innovative Series A, Series B. Of course, we are also involved into Series C for the company that we started the Series A at the beginning. This cluster is very particular, I would say, compared to the descriptions that we saw about venture capital funds. We are on the most risky part, and where the human contact is crucial for the development of the company along with the technology. Saying that, we don't pretend to detect all early stage opportunities, but we have a good samples of statistics, and we had identified basically 3 major trends. One is green tech. Green tech in 2 ways. One linked to renewable energy. So, for example, innovative way of productions of biogas, to innovative engineering on solar panel, or another clusters inside this category is, for example, the CO2 emission reductions. An example is, for example, we are working in clean tech linked to oil and gas industries, which is pretty innovative, especially these days. So some of these investments that are early stage can be more safe than investment into gold, I can say, because of the high demand, especially biogas, for example, in some European countries that are affected heavily by the current geopolitical situations. Another trend is probably the most hot at the moment, and we will discuss quite heavily tomorrow, which is linked to the NFT, Web 3.0, metaverse, and decentralized finance. I don't want to speak much about this because tomorrow will be a section, but just to give an example, one interesting project that we are working, which is a combination between NFT and fintech, where basically the platform establishes partnership with the best 50 wine makers, and what the platform is trying to address is specifically 2 critical issues on the high-end top wine. The first is about the origin, authenticity, and the condition of storage of the wine, and the second is about the control of the supply chain of the winemakers. You have to understand that high-end wine, 80% in Asia is fake, and mostly 50% in US and Europe is fake. So this is very crucial for this kind of wine to address. If we go about, for example, for the winemaker, if you drink a bottle of Romanée Conti where you end up in Hong Kong to pay even $25,000 for a bottle, when the winemaker probably sell the bottle for 800, even less. So this is an issue that this long chain is an issue for the winemakers because it doesn't make a profit out of that. So what this project is trying to fix with the blockchain is about to take control also about the quality of their product. And in addition to that, for example, issuance token can also help other buyer and seller to invest in the wine that is available in the platform, which are exclusivity vintage that you cannot buy anywhere else. So this is just an example about using NFT and fintech combined together. The other the third trend, which is, we see in different countries very largely, is about autonomous machine is linked to basically digitalizations and transformations, or better to say, vertical applications of artificial intelligence and machine learning, which an example in financial services, you see a robot advisory, financial chatbots, or you look into healthcare, it's about genetic analytics, it's about decision-making in specific treatments, in industrial artificial intelligence, for example, automation of process, which some are very trending, especially here in UK. There was a very nice closing of Series A, very interesting 2 weeks ago. So these are basically the 3 major trends.
Now, Anna, you mentioned you're working with the European Investment Council. What is the European Investment Council? What does it do? What's the role?
Yeah. So European Innovation Council is one of the largest funds in Europe with over 10 billion euros that is focusing on deep tech startups. It was launched by the European Commission, and it's a part of the Horizon Europe framework, which is a budget basically until 2027 that has allocated this money for European deep tech startups and for scale-ups. Essentially, also it's tackling, let's say, groundbreaking technologies, disruptive technologies, so anything from biotech to quantum computing. So for instance, when COVID hit, there was a specific call that was exclusively for the companies that are solving somehow COVID challenges. Then there was a cutoff date also specifically for the Green Deal companies. And essentially, there is a couple of components of this funding. So the funding is, the first component that we have is the EIC Pathfinder. So this is 3 to 4 million euros for very early stage companies. Those are projects that are delivered in consortia. Then we have the EIC Transition. This is 2.5 million grants for companies that are a bit more mature when it comes to technological readiness levels and in terms of, let's say, validation of the business model and things like that. And then finally, the most popular component is called the EIC Accelerator. So this is funding that provides to companies up to 2.5 million in grant and then 15 million euro in equity, which is so up to 15 million euro in equity, which is deployed by the EIF. And essentially, I think also based on what we've seen today, which there was many relevant remarks in the economic circumstances that we have and the whole kind of uncertainty and let's say inflation and interest rates and stuff like this, I would say it's very important to have such a player in the market who will kind of take over the risk of the private investors, at least in the early stages of such companies. So, yeah, I think it's becoming more and more popular. Also, the European Innovation Council name, it's not very intuitive in terms of there is kind of an investment component to it, but...
Have there been already some success stories that, you know, where the program really made a difference?
Yeah, absolutely. So far, there has been... I'm not entirely sure of the exact number of the unicorns that the EIC Accelerator has supported, but it's a bit less than 10, I would say. So we can detect that in Europe, the main unicorn successes were also funded by the EIC because there was a pilot. So from 2018, first there was a pilot phase in terms of the EIC, and with this new framework program, it started like a real deployment.
Right. Any question, suggestion? No? The other panel also mentioned that in private equity, continuation vehicles, right, have become popular and also needed, right, to a certain extent. Do you see this happening in venture capital as well?
I mean, I'll tell you on a very personal level, yes, I think it's necessary. As a firm, we've just launched last week the first opportunity fund, which is the equivalent of a continuation vehicle, but in venture language, that's ever been kind of put together for our part of the world. So the industry is very nascent. We have some seed funds, some Series A funds. There isn't a single Series B fund in our part of the world, in MENA or Africa. And so as our companies go out to raise their subsequent rounds, which they're doing very well, and they're doing it from the top VC firms around the world, and our funds have no more dry powder. This is the second time we've given up our pro rata to a follow-on company that Sequoia is leading. So it doesn't make sense that we don't have those continuation vehicles. And as the markets correct and the valuations come down globally, we're now able to enter our own companies, and we can obviously chair it because we have the information advantage, at a discounted value than what we would have entered at 6 months ago prior to correction, because we're not the ones pricing. And I don't think we're the only ones that will be doing this in the market. Like, I think it's a natural thing. As your companies become relatively cheaper to what they were last year, but they've grown twice as much, why would you not want to continue given you have the information advantage? So I think it's normal. I just don't think we'll do it in the private equity sense of their continuation vehicles in an evergreen structure, but rather they're just more fund cycles.
Cameron, do you see this also from the Preqin perspective?
It's something that we've certainly started to pick up on more recently. I mean, obviously, as you say, it's certainly more of an established trend in private equity. And we've seen, in absolute terms, the growth of that market's been very strong, but it's still interesting to note that it's roughly the same percentage of the overall PE market that it has been over the last several years. But definitely, yeah, we're expecting more activity with continuation in VC as well.
Coming back to the presentation that we've seen from Cameron, right, with those slides. For me personally, one of the most stunning slides was to see the divergence of the IIR, right, between the top quartile and the median and the bottom quartile, right? It was really stunning, I believe. So what do you think drives the impressive outperformance of the top quartile funds over the others? What drives that divergence?
That's a good question. I mean, if you look at it empirically, there is evidence of persistence of return. So I think it does kind of confirm the argument that higher quality managers do tend to outperform. It's there's less of an argument for that in the public equity space, but perhaps in venture capital and private equity, good teams, access to deals, and this all makes a big difference over time. And as I said before, I mean, obviously the venture capital market is entering into more challenging times, and I think that's why, especially now, that's becoming more critical, because we will start to see, the good quality managers being separated from the less quality managers. So I think that's going to be interesting to see it play out.
Noor, do you want to add? What do you think drives that performance?
I mean, I think it depends on the market. I think access to deals is key, and so in markets like the US where deals are very competitive, getting into the right deals is key. I think your entry price is fundamentally as important as your exit price. So when the entry price has started to rise and rise and rise, and if you don't have access to good deals and are able to really sit with the founder, you're going to overpay for that deal. So it doesn't matter where you exit at that point in time, you have to create so much more value to exit at a level that'll create those performance marks. I think in emerging markets specifically, I take a look at our markets, the VC industry is very nascent. It's like doing venture capital in the US in the 80s, right? So there's no competition on the deals. The competition is actually for the capital. But what it means is once you invest, you really have to work closely with your founders. So you have to handhold, you have to value create, you have to take the time and the energy to coach and guide and help them grow their companies. You can't just write a check and expect quarterly board meetings the way you would in the US. And so I think in different markets, different things drive that outperformance.
Right. So when you look at the whole venture capital model, right, it's broadly 3 phases, right? So Noor mentioned entry, right? Second aspect is scale up, and then exit, right? If you look at those 3 dimensions, which ones do you think in the current environment, right, that we're entering, Dr. Mohammed said, right, there are all these little fires everywhere. Professor Rubini said stagflation has become the baseline. So there's a new normal shaping up. Which ones of the 3 phases have become easier, and which ones are maybe an even bigger challenge than before, if you look at entry, scale up, and exit?
So I think that entry is definitely become easier. I think that a lot of founders are struggling to raise money. Most VCs I know around the world have set pens up. No one's writing term sheets, right? And everyone's waiting to see what happens, which isn't helpful, but it means you can pretty much give any founder money at this point in time at a reasonable valuation, and they'll take it. We have seen valuations come down across the board already, right? So when people say we haven't seen that yet, I'm like, then I'm seeing something very different. But we've seen it come down across the board, across the world in the last month and a half. I would say, with every crisis, exits become harder. Like, I'll remember in 2008, there was the GFC, the global financial crisis, and I happened to IPO a company in April 2008. It was the first company out of the region to list on the LSE and the NASDAQ Dubai. It was the world's largest interior contractor that I had helped scale. Morgan Stanley and UBS were the book runners, and it was all splendid. except for 2 months later, the market properly crashed, and we happened to have $420 million of cash on our balance sheet. And what that meant for us was I spent the next 4 years of my life doing global consolidation of adjacent verticals in our business. And it was so easy to acquire companies and to structure things that made sense. And by fourth-generation family businesses, 120 years old, at something that you could have the family values, but access to capital markets. So I look at that, and I think this right now is a time of consolidation, right? So exits are going to become harder because everybody wants to exit. Every company that cannot fundraise is going to want to find a nice exit for itself, even 50 cents on the dollar for the VC, but at least the founders make out okay and go do their next thing. So I think as the market for exit opportunities becomes more competitive, getting those exits done, right? And I've sat on the other side of that table 14 years ago, and I remember that very vividly. Getting those exits done now as a VC, as we take a look at our portfolio and say, who can we exit right now? Because if you want to exit them in a year from now, after their potential acquirers have already acquired something, that's not going to look pretty for anyone. So I think that's going to be the job over the next 12 to 18 months, is structuring exits.
Right. I mean, why do we do these conferences, right? I think it's this exchange, and it's a collective learning, right, that we want to enable. And in this context, I want to come back what I said at the beginning. The SoftBank Vision Fund posted a 27 billion loss. I think it started out as a 100 billion fund, right? So I was wondering, what went wrong there, and what can we learn from it? Who wants to take that?
I don't think anyone wants to take that, Matthias. I think
that's
a fair question. I think there's a lot of capital. Capital became cheap. It's one of those things that happened. You created value where maybe there was no value. There was there's perception of value. I'm not as familiar. Maybe the other panelists have an idea. We come from a part of the world where capital has always been scarce, right, for the founders. Like, you've never had this valuation inflation. Right. We always had an arbitrage in our multiples when we invested, regionally versus globally. So I think that too much capital.
Right. Yeah. So just to close up, what would be some recommendations from your side? How should investors look at venture capital? How to seize their opportunities? How to size it right? Anna?
Yeah, I would just like to follow up on this SoftBank issue. So I don't know if you've seen, there is this meme going around where, founders who come and say, I have an idea, immediately the valuation is like $10 million. The founder who wrote on the napkin, like kind of a business plan, the valuation is 20 million. So I think, the blowing up, all these, what you were saying about the capital, it's really an issue. But at least from the EIC perspective, I think, and let's say kind of this risk perspective from the founder, from one side is from the founders, right? Because I think fundraising was difficult even before this situation right now, and it's going to be even more difficult going forward. I would say that co-investing potentially with the financial instruments like we have at disposal in Europe, like the European Innovation Council, could be a potential kind of a buffer for private investors.
About value, yes. We were involved in pre-IPO a couple of years ago during the COVID, and we came across to some pre-IPO because we believe in technology, not because it was our clusters. And we pick up the right one, 20x in 9 months, and not even digital asset or crypto was able to do that. And we are talking about electric mobilities. But going back to your example about SoftBank, of course, this was a value created by inflating about the trends. Everybody wants to invest in electric mobility. So, this deal was particularly successful because the company needed cash. When we step into these discussions, and we get an amazing price. That's why we performed 20x in 9 months. But going back to reality, so let's go back to this real Series A, which has amazing technology, where we see companies probably don't understand, or probably they are waiting, where everybody speaks about green tech, ESG. But when is the time to invest into Series A with top technology, it's very limited. If the company was based in the US, the value was completely different. We have seen so many examples about this. Just even one round would be enough to perform like 20x because of the circumstances. One thing that we didn't discuss, I was not before in the other panels, but we are at the moment in one of the major concerns about uncertainty. Uncertainty about these situations that really make the investors just wait and see. But you have to understand that these startups cannot wait and see. We were, for example, astonished 2 weeks ago when there was a stock-listed multi-billion revenues company that pulled out of the deal just 1 week before the closing in front of the notary. And for the startup, it was an amazing shock about that, because after 4 months of due diligence, after even negotiating, finalized the agreement on the term sheet, and they walk away because they were impacted about another investment they did in Israel, or the loss about the sanctions that have a material adverse consequence on their business. So this is really, we have the moment, especially in Europe, where the market evaluations is very, especially for Series A, very serious. It's tremendous opportunity, but we have at the same time difficulties to sustain this technology because this strategy is about to invest. Because people will just wait and see. So wait and see, this company cannot wait and see.
No,
Sorry.
no, in VC, wait and see is maybe not the right approach. So please help me thank our panelists for this wonderful session. Good luck with your investments. All the best, right?